Hey, how's it going? Nice to see everybody today. I'm Stuart Elliott. I'm the editor-in-chief of The Real Deal, and I wanted to welcome you to our first panel today, which is how to save LA's office market. Can I get a show of hands? How many people are in commercial real estate? All right, nice, good number. So we don't have to dumb this one down for anybody. So I was talking to these guys earlier, and I'll introduce them in a second, but they told me they really suffer from FOMO. And it's not fear of missing out, it's fear of more office. Office space has suffered more than any other sector in real estate since COVID and remote work, and there's too much of it that we don't need. And for a lot of office buildings, distress is really hitting the fan right now. And no more. It's not more pronounced than downtown LA. That's really where you're seeing the hot spot. And it's getting scary there, and some of the prices are getting pretty scary there too, I'd say. We're talking about a third less than before the Great Recession, and the Great Recession was 15 years ago, so that gives you some context. And we might not hit the bottom yet. That's what we're going to find out today. So there's good markets too. Century City, touted as the hottest office market in the country, and then there's a lot of office markets in between that. So I've got with me on the stage two of the top investment sales brokers in LA who are handling a lot of these distressed deals. Kevin Shannon, right next to me here, co-head of capital markets for Newmark, which has been aggressively expanding and poaching broker talent left and right across the country. And as it stands, Kevin has been involved in a whopping $86 billion in deals since 2010. That includes Amazon's billion-dollar headquarters. And more relevant for today's discussion, he's been involved in a lot of the distressed sales in downtown LA. Market setting, deals like the Aon Center, 134 square foot. We'll hear more about that. We've also got Todd Tydlaska. He's a lead member of the investment sales team for CBRE in LA. Kevin and Todd used to work together, which is why they both have the Amazon headquarters on their CV. But CBRE is obviously the perennial big dog in commercial real estate. So it's great to hear from Todd today and get his perspective. So I talked with these guys a little earlier, and Kevin, actually this was back in March when you did the deal for the Aon Center, and you said there was some comfort you're buying near the bottom. So it's 6 months later now. Are we at the bottom yet?
That's the million-dollar question, and if I knew the answer, I wouldn't be on stage, right? I think we're scraping the bottom. I think there's some positive things out there. If you look at, last December, we sort of figured out how high was high on interest rates, but we didn't know when we were going to start going down. On September 18th, we're going to start getting rate cuts. We hope they're 50 basis points. It's likely 25 basis points, but I think that when you have uncertainty on interest rates, capital doesn't like uncertainty. So when rates were going up so fast, the market was free falling, and it was hard to get bids because again, capital doesn't like uncertainty. The fact that we know how high is high, we can see where rates are going, and they're getting better. The debt market's getting better. The healing process is happening. So from a capital markets perspective, I think we're at the bottom. I'm not going to say it was a month ago or it's 2 months ahead. I think from a leasing perspective, we've got a ways to go. It's market by market. Century City, as you said, is much different than downtown LA. But if you look at the sector nationally, slightly more than half had office employment growth last quarter. Just over half had positive absorption. So we're like at that inflection point. I think markets like San Francisco are getting ready to turn around. Other markets like New York had positive absorption last quarter. So I think we're scraping the bottom from a fundamental perspective, although some of these markets are going to take 3 to 5 years to heal. They're not going to heal in 12 months or 2 years even. And so, but when you know where the bottom is, then capital, I think that's when greed starts to overtake fear. We're starting to see that because we have really deep bidder pools. We're getting much more competitive processes. So it feels like it's getting better. I think we're at a point right now, if you have industrial multifamily product, your price in the first quarter is going to be better than the price you get in the fourth quarter because rates are going to be better. Fannie and Freddie's heading to 5 and maybe go lower. So I think we're scraping the bottom's the answer.
Yeah. And Todd, all these distressed owners, is the interest rate change going to change things materially for them, or is it still kind of, you're going to see the same level of distress pretty much?
Well, I kind of view your question on pricing is, have we bottomed? I view pricing fundamentals are similar to my sense of humor, which is it starts out okay and it drops way off. But if you stick with it, it's a U-curve, because eventually it comes back. And I think the challenge with office and the pricing you were asking last March, have we bottomed? I feel like we've been at bottom on pricing for 12 or 18 months, at least in the way that institutional investors have been underwriting real estate, which is to say super punitive. It's, I'm gonna give you credit for your in-place leases on a discounted cash flow basis, and that's my price, okay? And you get zero residual, you get zero land value, I'm just gonna take in-place leases and discount that back. That's the most punitive underwriting we're seeing. But you know who's taking advantage of this low pricing is your private investors that are just looking at basis, and then you've got users. And if you look at the breakup of users and private investors, 10 years ago, they made up, and it's just coincidental, all these 10s tie together. 10 years ago, private capital and users made up 10% of your investment market. This year to date, they make up 90% of your acquisitions in LA alone. So those are the groups that are taking advantage. The challenge is we don't have participation on the lender side unless you take kind of rip your face off type debt, from the Don Hankeys of the world, SOFR plus 600 at 60% with recourse. Like that's what it takes to get a multi-tenant office deal financed today, unless you've got seller financing, kind of back leverage. So the deals that are clearing, they either have back leverage, a super attractive basis, or a seller that's capitulating. Mm-hmm. And LA's been one of the markets where you've seen capitulation.
I mean, we're seeing that change, though. The owner-user part is right. I mean, the big deal last year was UCLA buying, the West Side deal, right, for $675 million. Like if you look at Seattle, 4 of the 5 biggest deals in the first half for owner-user sales, you're seeing, the first half of the year was not great for LA. LA had like $525 million of sales. It was down like 47%. And you only had one deal over $50 million in LA the first 6 months. And it was an owner-user sale. It was a school that we sold a project in Playa Vista. But that's changed. You've had in July and August, which is the third quarter, 3 deals much larger than that. You had 777 trade in downtown to a Chinese family office we brought in. And then you've had 2 other bigger deals. Mattel was an owner-user deal we did in El Segundo. You saw the Naveen deal with the Mateens in Beverly Hills. But so you've already had 3 over 50 in the 2 months after the first 6 months. And in the next 2 months, you're going to have another 8 over 50. Wow. So it's picking up. And these new sales, a couple of them are owner users. The big one would be the gas company deal if the county deal goes through. But you've gotten a lot more investor deals going. So the pace is picking up. What Todd described is historically correct, but I'm sensing a turn in the market. We launched 16 deals after Labor Day. Wow. And things are just feeling better, and we're much more optimistic. I mean, 3 months ago, I never would have told you pricing's going to be better in the first quarter than the fourth quarter because the pace of decline has been so steep. We're seeing that change, and there's a couple of comps that are going to print the next 6 weeks that are, I think, going to be eye-opening and very positive for the LA market.
So that's going to be, above 150 a square foot.
We're going to print $800, $900 foot comps. Yes.
Oh wow. So those are obviously not downtown LA. We're talking about.
We're not talking about downtown LA.
Well, you think about what's traded, right? It's been a lot of the problem assets, right? And they were problems for a reason. You had a hard time figuring out how you were going to lease it up, what rent you were going to be leasing up at. Part of what will help save office in LA is a return of tenants committing to space long term, because it's all a domino effect, right? And if we don't have tenants that are committing to space because they don't know how much space they need, when they're going to be able to get their people back, one of the biggest challenges in downtown LA is 40% of your daytime working population in downtown isn't required to go to work. So think about the lost tax revenue just buying a Danish every day at $10. That's $66 million in sales tax that we're not seeing every day. So that's a big problem for us. But Kevin's talking about some of the pending trades that are going to be high watermarks. It's the product that institutional or foreign capital is willing to toe dip back into the market. So your single tenant net lease deal with credit and term, your better submarkets. We've seen users pay up, $1,400 a foot in Beverly Hills. You just saw a $675 print. we're seeing institutions lean back in a little bit. The challenge is they've all got legacy issues that they just can't ignore as they go to raise money, to put money out. But there are a lot of institutions that are now office curious, trying to figure out whether it's now is a good time to get back into the market. I
like that, office curious. So you have 16 deals right now. I mean, Chairman of Newmark, Howard Lutnick, said he expects $1 trillion in distressed debt. So I mean, is this just the first inning, second inning? Are we going to see in 2025 just a crazy amount of deals, or what do you think?
I think I thought 2023 was like 2009 relative to transaction velocity. I was wrong. The first 6 months of the year, we actually went down another 8%, around 10%. And office was down 22%. I think by the end of the year, though, we're going to be 20%, 15% ahead of last year's volume. So the second half of the year is going to start the acceleration of transaction velocity. The distressed debt that you described, a lot of that's in the office sector, right? And so, like if you look at Fannie and Freddie, their amount of distressed agency debt's less than 1%, but office, just saw a report yesterday, is now over 11%. You're going to have a lot more distress. It depends who your lender is, though. Special servicers like to pretend and extend a lot, not always, as we're seeing with the gas company tower. But if Wells Fargo or Bank of America or JP Morgan is your lender, they're probably just going to blow it out and do an all-cash deal. If it's an ACOR or a Loan Corp or DB, Deutsche Bank, they're going to provide structure and try to get back closer to par. But we're seeing it, the deal velocity is picking up dramatically. New York's leading us out of this. If you look at the sales in the first 6 months, New York accounted for 20% of all the sales, 53% of all the gateway markets. New York's doing well. And if you look at, like in L.A., even if you're 70 or 90% leased because of what's happened to the capital markets, you could have a distressed capital stack. In New York, there's only 10% of buildings are 70%, less than 70% leased. In LA, it's like 31%, and San Francisco is 41%. So the West Coast is going to see a disproportionate amount of this distress activity.
Well, some of that is also the drivers aren't requiring their people to come to work. Tech as an example, Seattle, and we do the work for Microsoft, Amazon, Meta, Google. All of them want to kind of command their people to come back to the office, but they're all afraid to be the first mover. So, and every CEO that's drawn a line in the sand about getting their people back to work has had to back off that. So CB did this survey of all of our clients. 71% have a return to work policy. You know who doesn't? CBRE, because they're like, why create it if all these other CEOs aren't enforcing it? I think Kevin's point about it's going to get better, part of that is just sentiment driven, right? Everyone's paying attention to what's happening in the stock market. They're looking at unemployment. We see a little uptick, then it comes back down. It seems like every revision is to the negative. I think the first cut, I hope, is my hope for LA office, is that we see more participation on the lender side, because we haven't had that. Starting in June of 2022, the Fed put their thumb down to try to stem inflation on the federally regulated banks. Then in 2023, March, we had the regional banking crisis. Today, you've got your private equity that's lending, your debt funds, but the majority of the market is out of the market for lending except for CMBS, which historically has provided kind of bumpers for the market to show where each level of the capital stack prices. Today, we've seen double in the originations for office in the CMBS space, which is really helping inform where pricing is on debt throughout the stack. So that is cause for optimism for me. But in the meantime, it's really on the fundamental side. And if you look at across LA and across the country, the bottom 20% of assets is responsible for 80% of our vacancy. So the top end of the market is at its highest high in any of the markets around the country. The shoulder market benefiting from downtown LA's pain is Century City, but it's the same in Atlanta with Buckhead. It's the same in parts of San Francisco where you've got AI kind of taking up space. So I view it as cautiously optimistic, but it's going to be fundamentals driven.
And in kind of all this, do you think that office space usage is going to stay stable at this point? Like, to my mind, it's 33% are going in 5 days a week. It's 50% 3 days a week, and the rest fully remote.
We don't do office building tours on Mondays or Fridays. We always tour on Tuesday through, because we want butts in seats, right? And And the difference in pricing between a building that's utilized and a building that's on the market for sublease is substantial, both with equity and with lenders. But we are seeing, the return to work's getting better. You're seeing more people in the office on Monday. I mean, if you look at a market like Bellevue, they're now 20% below pre-pandemic. New York's getting there too. New York's activity on Mondays has gone up dramatically. You had the former CEO of Google saying the reason Google's so far behind AI is because people aren't in the office. And so greed is why people are gonna snap back and buy office buildings, but corporate greed is why people are gonna have to get back in the office. If you look at the job numbers, people are gonna start worrying about their job, and the easiest guys to lay off are the people on Zoom, right? Yeah. And so we see that trend getting better. And again, it's trophies and train wrecks, right? The tenants are leasing the trophies, but the train wrecks, which are a bunch of the buildings, a lot of our product, because what's happened is COVID has changed the way we use space. And the average, we've only gotten through about half of the leases that were in effect pre-COVID. So we still have 57% of the leases that have to roll, and on average, 13.8% of those tenants downsize. I mean, the downsize is on average 13.8%. So we still have to get through that roll. The return to work is gonna help, but psyche-wise, I think people have figured out how to use office space post-COVID. And one of the things that happened, in fact, CB just had a survey, the occupier group at CB just did a survey, and 80% of their tenants in the next 3 years want to expand. Contrast that to a year ago when only 20%. So the psyche's changing. You've got some positive things happening, but you still got to get through the rollover. But I think it's going to be trophies and train wrecks. The A product's going to perform well, and the B buildings that should be converted. When you look at downtown, I look at should these be converted. When I'm in suburban markets, should they be torn down, become industrial, right? Yeah. Because office is like the last choice for some of these buildings.
Well, it's not that we're oversupplied. We're just under demolished in office. So you're going to see more office go to residential, and right now, kind of the flavor of the day is townhomes. So if you've got a suburban project that's got low coverage and a big piece of land, the townhome developers are coming in unentitled or entitled, and we're seeing about a 50% discount if you're unentitled. But you compare that to a lot of the multifamily type 1 construction, like you've got zero land basis or negative land basis. And Kevin alluded to some of the conversions. If you look at a market like downtown, I think it's going to take a public-private partnership to get some of that inventory out of the market. And we did a bunch of work with Gensler. Only about 10% of the office stock works for a residential conversion, and you've got to be able to support new construction rents. Downtown, as an example, is trying to support a lot of new construction that's being delivered, and this adaptive reuse isn't cheap. So we've got a client in Chicago, Riverside Development. They've got a 2.5 million square foot project that they're converting to residential. They're gonna have a 50% loss factor. Their basis is negative $300 a square foot. But they're making up for that in city, state, and federal grants to get them back to zero so that new money in makes sense.
I mean, one of the reasons New York's leading us back is because the office to resi conversions make sense. The rental market's tight. There's parts of New York where the multifamily vacancy rate's 1.6%. My son's a renter there, I know. It's hard to get an apartment.
It's expensive.
And so the office to resi conversions are going on, and they're happening. What happened in downtown LA is 888 Grand traded, and Fowler Property Acquisition bought that for about $350 a door. When you have recent ground-up construction trading for $350 a door, the math goes out the window. So none of these conversions in downtown make sense. Todd's right, public-private has to come into play. You've got cities like Calgary where they pay you $75 per square foot when you convert an office building to resi. There are buildings that are suitable for resi conversion, but given the cost of capital, where the rents are, and then your exit pricing, which was just demonstrated, and the Canvas just traded as well at around $300 a door downtown. So the math just isn't gonna make sense for a while. It will come back, but it's taking longer. But when those conversions kick in, that's gonna be a very good thing for downtown and some of these other markets.
And will that take, sub $100 square foot pricing
based on the math today, $100 a foot doesn't work.
Yeah, 75 doesn't work. Because of the expansion, the return on cost needed for multifamily, and you're not able to solve for a 5, right? And costs have gone up. I mean, I was just talking to a developer today who just got a project approved in Bellevue. They're at $475 a door, right? And they're solving for a 5 3/4 return on cost. That's up 100 basis points from where they were kind of in peak COVID on pricing for multifamily, and that's new construction. You know, sticks over bricks, 5 over 2. But if you look across LA, like people are solving for wider returns in part because of some of the what I'll call governmental risk. And for a lot of investors, LA, California has just been X'd because they don't want to take the chance that another ULA comes down the pipe, which materially impacts value.
Don't talk about the mansion tax. Do not.
I'm definitely going to talk about it, definitely. So, I mean, just in terms of the demolition of office space, I mean, I thought it was interesting, Kevin, you mentioned 15% of renewals are downsized. I mean, can you extend that?
When you roll on average, based on Newmark research, tenants downsize 13.8%.
Got it.
So every time you get rollover, it's, okay, we got more supply, more supply, more supply.
Does that mean, and maybe this is a leap, but then office is overbuilt by 13%?
It's
Should
under
13%
demolished,
should
as
be
Todd
demolished?
said.
Right. So 15% of office should be demolished.
You know, when Green Street's come out and said, because of COVID and the permanent changes post-COVID, we're oversupplied 10 to 15%. The good news is, and by the way, this is true for all sectors, the pipeline of new product is being cut off because of the cost of capital. Right. So overbuilt multifamily markets, they're stopped. You know, industrial and markets like, you know, there's parts of Phoenix, Inland Empire, that pipeline's stopping. The same for office. Office, who would build spec office in the current environment? There are pockets, by the way, like Midtown where you're 8% vacant, and One Vanderbilt. You've got Cherry Creek. You've got, you know, Bellevue's actually doing great, although it has some headwinds still. But you got markets like Century City where your new construction in Century City is getting rents that start with a 10.
They're doing $12 rents there, which is higher than we've ever seen. And even the secondary product of that market is doing double-digit rents. But I think that who would do new construction today? It's a private investor that can capitalize it themselves, because to Kevin's earlier point about uncertainty, I believe that more money will be made this cycle in the office sector than any other product type because of how out of favor it has become. The challenge is you don't know how to capitalize that because of duration. You don't know if it's 4 years, 7 years, 10 years. So you've got buyers like Joe Wen, who just bought in downtown San Diego at $85 a foot, who just believes intrinsically. And by the way, Joe Wen is a single-ply toilet paper type landlord, right? He's cheap, and he's going to operate the building cheaply, okay? Dr. Lee, same thing. There are Dr. Lee clauses in leases.
Joe just gave $100 million to UCI, so be nice to him.
True. That's true.
He's rich. I won't deny that.
Be nice to him.
All that toilet.
Dr. Lee's nice too, but he is cheap. But the point is, many of these private investors are buying for basis. They're focused on filling up their asset. They're willing to undercut the market in rents. They're not going to play the greater fool theory game, which is, okay, if I give $200 in concessions and 12 months of free rent and I buy up my face rate to 32 net, I'm going to get capitalized value on that. They're like, I can't buy dinner with IRR. So they're focused on what is my net cash flow, what is my ROI on my actual dollars invested. They're really looking at what's below the line. And by the way, they're throwing CapEx above the line. And so that they're accounting for what do I actually take home every day. But what I'm hearing from increasingly from investors is because office has been so expensive to maintain, many are trying to de-office their portfolios all at the same time. And they're not buying from one another. That being said, those office-curious investors are saying the spread between core industrial, which is back to a sub-5 cap for core, you know, well-leased credit, A-plus location, to office, which is a 6.5, like it doesn't feel like there should be 150, 200 basis points. And by the way, Beverly Hills shouldn't be pricing the same as New York, Manhattan, or in Chicago. And there is a lot of commodity product Kevin was talking about that's 9 and 10 caps. And that's whether it's 40, 50, or 80% leased, just given where the market's at.
I mean, the commodity products like 11, 12 caps. I mean, you're going to make a lot of money, but you got to be careful. It's like when you came out of the GFC, the rising tide lifted all boats and everybody came back. With office, you're not going to make money on every deal, even just because it's cheap, because the TIs have gone up with inflation. Everything's so expensive. I mean, we sold 777 for $120 million to a Chinese family office that lives in Rancho Santa Fe. but the capital, it looks really cheap, right? But the property condition report had $32 million of capital.
Well, yeah.
And your TIs are $190 a foot. And so if you want to do a market deal on a 12-year lease, you don't get any money out until after year 6 or 7. So it's for patient long-term capital. Are these guys going to make a lot of money in the long run? Not everyone will.
That's not what your BOV said. It's got the residual of $500, $600 a foot.
No, but by the way, these family office guys, that guy didn't use Argus.
No.
These guys don't have exit pricing. They don't. They're doing the back of the envelope, going, this is really cheap. It costs $1,000 a foot to build, and it does. But you need the demand side of it. You need the operational side of it. I wouldn't just say, hey, if you buy office now, you're going to make money, because you're going to have some bad deals, and then you want to focus on the good locations, the better product, because there's a lot of office that's going to end up getting demolished even though you bought it cheap. So you still need to be careful.
No, there's a lot that's cheap for a reason, right? Because you don't know, even in good times, in 1800 9th in Seattle, I don't know how long it takes to lease up that building in this environment. I didn't know back in 2017, 18, 19 with the tech run up how long it would take to lease up that. So the commodity, I agree, you kind of need to shy away from. But I feel like in 2024, 2025, you can be an asset and a market picker, because your counterparty just wants to clear. And in some cases, they're clearing at any price if they own free and clear. If it's a lender, like a B of A, a JP Morgan, Wells, they're looking at 2024 as a non-production year. So let's just clear off any of these bad assets. And by the way, they're not providing back leverage.
Yeah, but even Wells has switched. They've taken some lumps on deals they've taken to the market. And so because of what's priced out, they've actually started being more cooperative and doing workouts versus just blowing stuff out, because let's just blow it out, and you think it's going to be 170 million, it prices 120. You do that enough times, and you're like, you know what? Maybe we should look at this workout. So even some of those guys are starting to get more flexible.
Yeah, we're working on 28 different restructures right now, all in various stages, various markets in the West. And if you had to categorize the various groups, the banks, particularly the regional banks, and apologies if anybody here is from a money center bank or one of the banks, they have been...
Or Dr. Lee or Joe Wen.
Oh, Dr. Lee knows I love him, and he'll admit he's cheap. They've been head in the sand about where valuation is. And we've had this gap between public market valuations and private market valuations as indexed by like the Odyssey funds. They're still carrying office product at a 5.7 cap. The public markets, if you just aggregate all the public REITs, are at an 8.7 cap. So you get 300 bips of spread between the two. The banks have kind of their head in the, hey, our stuff's worth a 5.7 cap. It's appraisal based. It's backwards looking. The public market's like, look, we're looking at where cap rates are going for the next 6 to 12 months. So there's been this big spread. So you've got your banks in one category that are looking at yesterday's price. Your debt funds, particularly those that have an equity side of the house, a lot more rational about where value is today. They don't want to take their lumps. So they're restructuring where they can. If you've got a competent, willing borrower able to put new capital into the deal, they'll work with you. Your insurance companies, probably the most workable group in terms of restructuring an A to a B, providing some structure around roll, new capital into the deal. And then there's the syndicates. Those are really hard to work because you have people with a bunch of disparate interests. I mean, Kevin helped Robert Sarver buy a piece of debt on Pacific Corporate Towers. That was a massive deal that only happened because all of the debt was converted to equity, and now all the buyers or all the investors are shoulder to shoulder on new equity into the deal. So I think we're early days in some of these big restructures, and I think you're going to see more of that in 2025, which is good for my business because we only get paid when things transact.
Yeah, and can you take us inside some of the flavor of, you're working on 28 restructurings right now. I mean, what is it like around the boardroom when these, properties are getting worked out? It's got to be very ugly and
well, it depends,
painful.
Right? So for your debt funds that have an equity side of the house, like they're pretty rational about where pricing is because they're out in the market, and they've also, by the way, got legacy issues, so they know which counterparties are kind of workable in terms of restructuring a deal. Mm-hmm. The banks, Wells is changing their tune a little bit just because of how punitive the pricing has come back, and on things they've cleared, they've really taken their lumps. B of A, kind of same thing, JP Morgan, all of them are a little more attuned to how do I lose the least amount of money on this transaction. Nobody wants to look like an idiot either. So a lot of these negotiations have been kind of party to party without an intermediary. So the fact that we're involved in 28 of them provides a pretty good proxy for how things are going for insurance companies, your debt funds, your regional banks. It kind of depends on the deal. In some cases, the bank may say, look, we just don't want to touch it. We're just going to take this back and clear it. Deed in lieu. I don't want to pay transfer taxes. I'm just going to sell it deed in lieu. In other cases, it's like, how do we work together? But we're advising folks, you've got to be into it for at least the next 3 to 6 years, depending on the profile of the asset. Because if you're only giving somebody a 12-month extension, you're back at the negotiating table in 6 months.
Mm-hmm.
And we just did a rescue capital deal on 29 buildings. We also restructured US Bank Tower downtown. It's you try to make it a win-win for everybody, and it's every deal's a little bit different. But the problem is, if you look at L.A. on a Newmark research, only 31% of the capital stacks for office. 31% can meet debt service, and even those need to deleverage. So it's every debt maturity is an issue. So if you have 29 loans, office loans, and 29 mature, you got 29 workouts.
Wow.
But there's a lot more office loans than that. So it's what we're doing is we're doing a lot of work, advisory work for the banks and the special servicers, and it's just, and by the way, we can bring rescue capital into good submarkets like Santa Monica and West L.A. There's no such thing as rescue capital for downtown L.A., right? It doesn't exist. Then you go to somebody like a Don Hankey, who's a bridge lender, and that's really your only capital for those types of markets.
Yeah. So I want to ask a little bit more about buyers and sellers downtown. So you have Brookfield, obviously, one of the biggest losers of office space in downtown. Like, what do you think of their approach to investing? Was it their approach, or it was just a perfect storm, and that was what caught those guys out?
It was just a perfect storm. I mean, everybody, if you look at downtown LA, Brookfield bought the portfolio after we sold OUE out of Singapore, US Bank Tower. And Brookfield didn't want to own that. So when we sold OUE, US Bank Tower, then the portfolio traded. At the time, there was three or four people trying to buy the portfolio. Everyone believed in the 24/7, the live, work, play, population increasing, all the good things happening in downtown, which still many of it still happened, right? The lack of population is another issue, and we can talk about our government, but yesterday Biden gave the government workers in D.C. another 6-month reprieve from going back to the office. So in these CBDs, government employees, as Todd said, are very important. But it's going to be a process. It's going to take time. Things are getting better, and by the way, I'm just looking at our deal flow and what's happening, and I just described what's about to close in L.A. It's refreshing, and so I do think when you see these benchmarks, by the way, and one of the things that's important is to get people like Blackstone and KKR and Brookfield back into the office. Brookfield made a bad bet in downtown. If you ask them, we made a bad bet. Did anyone know COVID was going to do what it did to the CBDs? That story exists in all the submarkets, and so it was a bad bet. Brookfield's a great operator. It was just a bad bet, and CBD bets, like look at Donald Bren. I mean, Todd just referenced Symphony Towers. Bren bought a bunch of product downtown San Diego. It didn't work out.
And those guys never sell.
They never sell, and by the way, to get out of that, he had to cut a big check.
Yeah.
And so the CBDs, it wasn't Brookfield's fault. Brookfield's a great operator. It was just a bad bet, and nobody knew what was going to happen to the CBDs.
And that's one market. So it's like every investor in New York, a bad investor because they lost money in the city. I think it was a perfect storm, particularly the capital markets. And I think disproportionately, office has been penalized this time, whereas during the GFC, it was more distributed, right? The pain was spread across multiple product types. Now the pain is really acute to office. So in Brookfield's defense, they're a great investor. There's a reason that they raised $10 billion funds, seemingly overnight. They have one of the fastest fundraising performances of their peer set. I think it's just a function of really bad luck in a market where in many of the other CBDs, you've seen leadership require people to get back to work. I've got a quick survey for the audience. You can yell out if I point in your general direction. What do you think the average federal employee logs on to? And this is coming from the Real Estate Roundtable, not Todd Tydlaska or Newmark math. What do you think the average federal employee logs on to their network on Fridays? Throw out a number. No, not percentage, number of hours or minutes a day. An hour, 6 hours, 3 hours? God, we would be so productive if that was accurate. 26 minutes.
No. Yikes.
I wish I was kidding. That's the average
not good.
log on to the network, not productivity or how much work you're doing. Maybe they're taking Zoom calls that are not on network.
Yeah.
But to me, that's a leadership issue. And if Biden's given another 6-month reprieve, like, I don't want to get into politics, but we need leadership that tells people they've got to get back to work, whether that's office employers, folks in finance. The markets that have the best return to work are Dallas, New York, Miami. It's a lot of the red cities and blue states.
Yeah.
So what I've seen is that we've seen a much slower return for the West Coast, and that's Seattle, San Francisco, and LA. Though I would tell you, in San Francisco, AI is so particular about their IP that they're in the office 6 days a week. So if you're working at one of these hot AI startups, you're in the office 6 days a week. There is no coasting. There's no taking a Zoom while walking your dog from 8 to 10 on Friday mornings, okay? So look, I'm a work from work type person. Maybe I'm old school. I haven't been doing this forever, but it feels like a lot of it's just coming from leadership that needs to get people back to work. My 2 cents.
Let's talk more politics. And ULA.
I think we're almost done. I don't know if we're going to be able to get to politics.
Well, I'm going to ask you the big question then. What does LA need to be doing at the government level that it's not doing?
Well, CB is spending a lot of time with leadership around LA. A lot of people that are native Angelenos know we're made up of 44 different cities, right? Each with their different planning departments, each with their different goals, each with their different budgets. The city of LA is kind of the nucleus and kind of has the greatest spillover effect to the balance of the city. We are doing a lot of education. We're doing a lot of education on what it means to have your people back to work, what that means for kind of street friction in downtown LA as an example, what it means for transportation. I'm a very proud Angeleno. I'm not super excited about the World Cup coming to LA in 2026 in our current state. And it's to say nothing about what 2028 is going to look like when we've got the Olympics here. So what are we doing? What is leadership doing? They're doing a lot of analysis. They're doing a lot of study. I had kind of hoped that we had a billionaire business leader that could have been our mayor that would really enforce.
Yeah. By the way,
And he's an SC guy. And I know there's a lot of SC fans in the crowd. So I've tried to use short words and speak very clearly as a Bruin up here. But no, what are we doing? It's a lot of education and I hope some action because it's been like measure, no cut in my experience thus far.
I mean, and by the way, Rick Caruso would have been a great mayor. He would have been fantastic. But if you look at it, politics does come into play. LA is going to be pristine by the time the Olympics come. It's going to be spotless. It's going to look like Singapore, or as best we can.
It's going to look like
close.
San Francisco when Newsom cleared it out ahead of the Chinese delegation.
And so, but if you look at it, what politics did, like in Seattle, Bruce Harrell, when he got elected, he changed the security. I mean, you had the autonomous zone and people going nuts, and you needed to have some sanity come in. And then Bruce Harrell got elected in Seattle, and then you had new city council people, and it's coming back together. If you look at, Gavin Newsom did rule on the homelessness and the ability to move these encampments. Well, guess who's running for re-election is Mayor Breed, and so she's cleaning up the city before the election. But Karen Bass could do the same thing. She's chose to go about her existing program, but she's not up for election. So, one of the things that I can't underwrite, because we do, our team may do 100 deals a year, right? All over the West Coast. And I can't underwrite leasing up buildings if women employees can't go there and don't feel safe. I don't know how to underwrite that leasing velocity because that building may not lease. And so we've got to make everything more secure, more safe. We got to get people back to work. There's a lot of things we need to do because when the government allows DC, which dominates that CBD, not to have their employees go to work, they're killing the restaurants, they're killing the bars, they're killing the dry cleaners, they're killing all these good families that have been running their businesses, being an amenity for these CBDs. It's a horrible thing. And the other thing that we haven't reckoned with that's going to come into play is what happens when people see the property tax revenue go down and down and down, because these valuations are going from, I mean, 3 years ago I sold a building in downtown LA, 915 Wilshire, for $508 a foot, and I just sold last month 777 Fig for $117 a foot. When you look at the tax revenue that's coming in and going down and down with these, because everybody's going to start appealing their taxes, so it's a little bit of a doom loop that needs to be fixed, and hopefully it gets fixed.
The one thing leadership is doing, they're listening, right? And so use this as kind of a call to arms. Call your city council member, call the mayor's office, tell them what you think about people not being downtown. Tell them you don't feel safe in downtown. They are listening and they're willing to respond. They're not up for election, so maybe they can act. Tell them you're worried about the 2026. One thing real estate does a really horrible job of is working together, not like, in the Northern California, you've got a lot of folks that work together in the tech industry, right? And they're looking for policies from the state of California, policies that they're pushing for to help the tech industry in Northern California. We don't lobby very well as a real estate industry. So call your city councilman, call the mayor's office, do what you can, send an email, send a note, because we don't do that. We don't lobby. There are certain organizations, be that ULI or NAOP, get involved, because if we just sit here and complain, nothing's going to happen, or you're going to get out of it what you put in, right? So use this as a call to arms. I'm going to stop. This is not my political box to stand on, but if you don't like it, speak up.
Well, I think one thing that's lacking in LA is just one central lobbying body. It's like in other cities, like New York, for example, you have one big
Real estate board in New York.
Exactly.
Yeah.
And
But we also, like ULA only affects the city of LA,
Right.
and all these other cities are like, oh.
But Santa Monica followed suit, Culver City followed suit. It's like, okay, let's just go after the rich folks. Let's just tax business. Like, it's not good business, and they're not seeing the revenue. So what are they going to do, Kevin? They're going to raise taxes somewhere else. Like, if one spigot turns off, you open another door, turn another one on. Mm-hmm. That's what I think.
I'm going to avoid politics.
So last ULA, it's pretty hopeless at this point that it's going to get overturned, right?
It doesn't look good. It doesn't look good.
Not good. Yeah. So it's going to just be baked in. Well, let's switch to some good news as we wrap up here. Best office market is Century City. Can you tell me about what's going on there and some of the other markets you're seeing that are the strongest right now?
Well, I think it's the spillover market. So you've got the out of favor CBDs, and so one market in a lot of these cities. Kevin mentioned Cherry Creek in Denver. If you look across the West and you look across the country, whether it's Buckhead in Atlanta, that's coming out of the CBD, and it's largely professional services, financial services firms that are taking space. You look at a company like AEW, they're going to pay double rent for 2 years, and they more than doubled their rent to move to Century City, in part because of the quality of life and the fact that their women can, not just women, their people can go to work and feel safe. So why is Century City doing well? A couple things. One, enforcement of rule of law. Two, setbacks for the buildings where they're not just on the street. Three, homeless encampments don't exist in Century City. Miraculously, they're just told to move along. I think what a lot of the Century City and Beverly Hills folks were worried about was having the metro stop right in the middle, because that has caused some additional street friction in markets like Santa Monica, where they've been looser enforcement of some of the, what I'll call street friction. So if you look at the best performing markets, they've got a ton of amenities. So the mall had $1 billion renovation. That's been well received. It's got limited stock, so the stuff that's around the mall is doing well, but Century Park East still has plenty of availability.
I mean, there are really good markets performing around the country. If you go to Bickle in Miami, you go to Midtown, it's Cherry Creek. We're just taking a deal out in Southwest Las Vegas. Rent growth in Southwest Las Vegas has been 28% the last 3 years. It is, and there's a waiting list on a couple of projects to get in the building, and it's because there's a lot of reasons, but a lot of things that Todd mentioned. But the Cherry Creeks, the Bellevue feels safe, whereas if you go to downtown Seattle, there's parts that don't feel safe. Century City's a bubble, and it's clean, and it's safe, and it's expensive. And by the way, people are utilizing space there much more than they are in some of these other CBDs. So it's a winners and loser market. I've never seen such a bifurcation. You don't have that bifurcation in the other sectors, by the way. It's really unique to office, but it's like when you're looking at $31 rents in downtown with $190 in TIs, and you get 10 to 12 in Century City, being in those location is always, real estate's always about location.
Yeah, I think it's interesting that the markets where you've seen capitulation, like a Denver, they hit a new low water mark of $40 a foot, right? And yet Cherry Creek's getting the highest rents it's ever seen. That $40 a foot was in the CBD. Similarly in LA, we were $95 is the low comp so far for our downtown. But Seattle's now a $60 a foot market on the low end. Portland, $50 a foot. Downtown San Francisco, we saw a $75 a foot print. Downtown LA, I think maybe we haven't traded the right stock, but we're buoyed a little bit. Orange County Airport market has been an interesting market where we saw capitulation early, and you saw pricing that was a third less than what we saw during the GFC. But downtown San Diego at $85 a foot, like, can you lease it at $85 a foot? I guess we'll find out. But as you look at the markets that are benefiting, it's been either coastal in a lot of Southern California. It's been the markets that feel safest, that has the nicest product, and it's expensive.
By the way, I want to end on a positive note.
Yeah.
The markets are coming back. Bigger is starting to come back. The conduit market, I think the volume is going to go from 40 to 80 billion. We're seeing a lot of bigger deals. Our debt team in the last 6 months closed 15.2 billion, and so those deals weren't able to be executed, 90 days ago, a year ago for sure. But and most of these are not office deals, by the way. They're different sectors, or casinos, or multifamily. But you're seeing that open up, and all these big deals are getting swallowed up. A lot. By the way, data centers are the ones that are probably the most popular. But things are getting better. A year from now, it's going to be a completely different environment, and you're going to be talking about a lot of trades. And so things are opening up, and the data points are coming, and once you build the bottom, you just work your way back up. It's going to take a while, but it's coming.
Yeah,
it's my sense of humor. You're hitting that bottom of that U-curve. We're coming back.
Well, you guys are going to be busy, it sounds like. I mean, working through this pain, and 16 deals, 28 restructurings, so watch for these guys in the news stories we're writing. I'm sure there's going to be a lot of deals coming down the pike. Thanks, guys. Thanks, Kevin.
Thank you, Stuart.
Appreciate it.
Thank you.
And next is up is Jerry Sullivan, our national editor, and he's going to take the next panel. Thank you, everybody.